So, hello everyone. I hope you all are doing good. Today we'll discuss about this topic, that is the cost structure uh, regarding any venture or anything. So, coming to the topic, a cost structure derives all the costs incurred to operate a business. It's essentially the blueprint of how your business spends money to create or deliver value. Think of it as an answer to this question: what are the all the costs that are involved in running my business? Cost structures are typically divided into two main categories. First is the fixed cost, and second is the variable cost. Fixed costs are the costs that don't change with the level of production, like rent, salaries, or insurance. And variable costs are the costs that fluctuate with our business activity, like we should say raw materials, packaging, or delivery expenses. Let's look at some more examples. Regarding fixed cost, this is the office rent, software subscriptions that we have, and employee salaries that we give, equipment depreciation. And variable costs include, first is the raw materials, common base wages, packaging, and utility bills in some cases. Okay, and our model will determine the balance between fixed cost and the variable cost. For example, a software startup may have low variable cost but high fixed cost, and vice versa. How does understanding our cost structure helps? Like, understanding our cost structure helps with the first is pricing strategy. If we know our cost, then we can know how to price our product to stay profitable. Second is the break-even analysis. It helps us determine how much we need to scale our business so that we can come to no profit, and so that we can cover all our cost. Investor communication. Investors want to know how lean or scalable our business is. And for this, financial planning helps in budgeting and preparing for cash flow needs, etc. And a solid grasp of cost means smarter decisions, less waste, and more chances of success of our venture. Some startups adopt a lean model, minimizing fixed cost, and some think of a drop shipping or e-commerce store, like no inventory, no warehouse, minimal staff. This is the lean model. Others, like manufacturing companies, might have a high cost heavy model with high capital investments, machinery, and staff. Both models can work out, but each comes with different risks and benefits. Okay. Before launching or scaling our businesses, first we got to ask ourselves, what are my largest cost drivers, and can I outsource or automate cost heavy functions? What happens to my cost if I double the sales? Can I switch fixed costs to variable ones? Or what costs are essential versus what costs are optional? These questions guide us in optimizing our cost structure to improve sustainability and growth. Okay, so coming to the tools to analyze cost structure, there are various tools to derive the cost structure, and you don't need to be a financial wizard to manage the cost. You can use these tools. Like, first is the business model canvas. It is a visual tool that includes cost structure as one of the 9 building blocks. And one is the break-even calculator, helps finding how much you need to sell to cover the cost. And third is the cash flow forecasting tools like Excel, Notion, or budgeting apps that show how costs evolve over time. Startups should review costs monthly to spot inefficiencies early. And there are some common mistakes that we should avoid, and they are, when it comes to cost or calculating cost, they are like ignoring hidden costs like transaction fees or customer service, overestimating revenue and underestimating cost, locking into long-term contracts too early, not revisiting cost assumptions regularly. Avoid this and you are will be already ahead of many. Okay, so wrapping up this cost, to knowing your cost structure is not just about saving money, it's about creating a sustainable, scalable, and profitable business. Start small, review often, and build with your numbers in mind. If In this way, you can come up with a better efficiency and scale your business onto the next level with and make it profitable so that uh, you can invest more and more and generate more profits. So yeah, let's come to the practical part about cost structures. So first we will discuss some basic terminologies in order to understand the cost structure and how we calculate it. So yep, here are the terminologies starting with the first one, accounts payable. Accounts payable is an accounting entry that represents a company's obligation to pay off a short-term debt to its creditors or suppliers. For example, when you purchase a raw material from your supplier but pay after a month on receiving the invoice. Second is accounts receivable. When customers buy your products or service on credit and pay after a certain amount of time. After receiving the invoice, it is called accounts receivable. For example, think of your internet or mobile bills. You use the service mostly for a month and then pay the money after your service the invoice. Accounts receivable refers to the outstanding invoices a company has or the money clients of the company. The phrase refers to an accounts business has a right to receive because it has delivered a product or service. And accounts receivable or receivable represent a line of credit extended by a company or normally have terms that require payments due within a relatively short period of time, ranging from a day or to a fiscal or a calendar year. So coming to the assets, a company's balance sheet statement consists of its assets, liabilities, shareholders, equity. Uh, Assets are what your venture owns, including cash, equipment, money receivable from customers, accounts receivables. For a cash-based business, a coffee shop, food delivery service, there won't be receivables because you collect money before as soon as the product or service is delivered. But for the business that involve invoicing a customer, for example, you build websites and the customer will pay after you deliver the websites and they are happy with it. When you have sent out invoices and you are waiting for your customer to pay, then they are called receivables. Assets are divided into current assets, those which can be converted into cash in 1 year or less, and long-term assets, which will take you longer than a year to convert into cash. A fixed asset is bought by a business for production or supply of goods and service. Examples of fixed assets can be equipment or a delivery truck that a business has bought for itself. The term fixed means that these assets will not be used or sold up within the accounting year. A fixed asset typically has a physical form. It is reported on the balance sheet as property, plant, equipment, PP&D. Balance sheet. A balance sheet reports your venture's assets, liabilities, and shareholders' equity at a specific point in time. It is a financial statement that provides a snapshot of your venture, of what your venture owns and owes, as well as the amount invested by your shareholders. There's a snapshot representing the state of your venture's finances at the moment in time. The balance sheet is based on the fundamental equation assets is equal to liabilities plus equity. When entrepreneurs start their businesses, even before they start selling any of their products or service, they will have certain expenses. These are the fixed costs like electricity, rent, salaries, etc. Their first focus will be at the least sell enough to cover such expenses. Then they can focus on how to sell more to make profits. A break-even analysis is are useful to find out what point your venture or new product you are thinking of introducing will be profitable. It is a financial calculation used to calculate the number of units you need to sell at least to cover your costs. When you break even, you are neither losing money nor making money, but all your costs have been covered. You can use the break-even analysis to also assess the viability of new business idea. Performing such a break-even analysis calculation can give you your team a general sense of whether the idea is worth pursuing. If your analysis suggests that you would have to sell 8,000 t-shirts before you can make a profit and it will require an investment of 10,000 to get going, you can make more informed decisions regarding whether that is possible for you to sell those many t-shirts. It helps you evaluate different business ideas and pick the one you are most comfortable with. Cash flow. During the day-to-day operations of the venture, cash comes in and goes out. Cash flow is the amount of cash that venture receives or pays out for the way of payments to creditors. Successful entrepreneurs always keep an eye on their cash flows, looking at how much money is coming in or going out, also called the cash flow analysis. Is a good tool to analyze the liquidity position of your venture. It gives a snapshot of that amount of cash coming into the business, from where, and the amount of flowing out. Cash flow statement is a financial statement that summarizes the amount of cash and cash equivalents entering and leaving a company. It measures how well a company manages its cash position, meaning how well the company generates cash to pay its debt obligations and fund its operations expenses and the growth of the company. So next is the cost of goods or COGS. COGS stands for cost of goods sold. It is all the direct costs attributable to the production of the goods sold by your venture. And this amount includes the cost of raw materials used in creating the product and the direct labor costs used to produce it. It excludes indirect expenses such as distribution and selling cost. Cost of goods sold is also referred to as cost of sales. If you buy let's say if you buy a product from a third party vendor, for example, you buy cakes from a local bakery at wholesale prices and sell it in your cafe, or buy t-shirts from a manufacturer, then consider the amount you pay per product at the cost. However, please remember to include any additional cost if you add to the product. For example, if you put the cake in a box that has your brand name, then you should also include the cost of each such box into the basic cost of the product. Liabilities are the money that your venture owes to outside parties for from bills it has to pay to suppliers and loans you took from others, etc. Current liabilities are those that are due within 1 year, and long-term liabilities are due for more than a year also. Profit and loss statement. Profit and loss statement, or say P&L statement, is a financial statement that summarizes the revenues, costs, expenses incurred during a specific period, usually given a month or a fiscal quarter or a year. It also sometimes referred to as the income statement. It provides information about your venture's ability or inability to make profit by increasing sales, reducing costs, or both. The statement reveals the ability of your venture to generate profit. The P&L statement is typically for a specific accounting period, so it is important to compare the statements from different accounting periods, as the changes in revenue, operating costs, and net profits or losses across the different periods are more meaningful than the numbers themselves. For example, your venture sales may grow, but its expenses might also grow at a faster rate, thereby reducing your profits or even making losses. So yeah, these were the basic terminology. So let's us understand how do we calculate, let's say, cost for a basic startup. This is a basic Excel calculator that we can use. So first, this is a one first sheet, and here we fill up the startup cost. Like say, what are the fixed cost of our startup? Like all those initial costs for, like, let's say it's a manufacturing company, we need a plant or something. Or if it's a software company, we need some, let's say we need some hosting services, etc. That kind of things we put here. Then we put the capital that we working capital in progress. It's also fixed at starting operations, like some basics operation that we need to start, like say reach out, like let's say something research or something we put here. Then all the it calculates the automatically calculate the overall share startup capital. Then the second thing is the COGS calculator. So yeah, this is the COGS calculator. COGS calculator basically calculates the cost of goods sold. So it will incorporate raw material, packaging, labor cost, etc. Okay, so coming to the third slide, that is the sales forecast slide. In sales forecast, we have the months on the y-axis, and on the left side we have your number of units sold, product category, revenue, price per unit, and then from that we calculate the cost of goods sold and cost per unit. Okay, so this slide contains all the salaries. Like we put all the salaries of the CEO, CMO, employee 1, 2, 3, etc. It will automatically total all the salaries and give us a brief idea about how much we will be spending on the salaries. So the next is P&L forecast. With all the details that we filled earlier and more details we will fill, it will automatically calculate all these numbers for us. The cash sales, number of customers, price per unit, or the cash receipts, total sales, COGS, fixed expenses, that is salaries, marketing and promotion, digital marketing, utilities, customer service, rent, total. And after all this calculating, it will give us the results automatically, like the net P&L that we are having, the gross profit margins that we are incurring, and the net profit margin that's remaining with us. Six is the break-even analysis. So as we discussed earlier, what is the break-even? So here we'll see what is the break-even sales level. The break-even sales level is the number of units that must be sold in order to break even. This means that the revenues are equal to the expenses. Any unit sold beyond this quantity will allow the company to generate profit. One of the best use of break-even analysis is to play with various scenarios. For instance, if you can reduce the cost of producing an item, that will be the impact on how much units you need to sell. You can use many what if scenarios to arrive at the sales that your team can achieve. Formula: break even point is the total fixed cost divided by the gross margin upon total sales. Okay, so this is this is a calculator for the break even analysis. This contains like average sales per unit, average cost of each unit, gross profit margin, fixed cost for the year, sales required to break even. It will show us number of units sales to break even, profit margin for the year, total sales for the year, contribution margin, gross margin or total sales, total fixed expenses, operating expenses, break-even sales annual, and gross margin of sales, total fixed expenses, yearly break-even amount, that is the break-even amount that we need to reach on a yearly basis, and the monthly break-even amount, that is the break-even amount that we need to make on the monthly basis. Okay, the next slide includes is about funding. How much funding we need to get. It will show us how much funding we will need in the year one, year two, year three, year four, and with all the costs that we are occurring. Like it will take mostly the data from the previous sheets that we use. Some of the data will be needed to update here, but most of the it will calculate from the previous sheets, and it will show us how much funding we should take in order to make our venture grow. Okay, or we should say make our venture sustain. It will show for all the 5 years. EBITDA will show us the earnings that we will be incurring before the tax deduction and etc. things. Okay, so these are the unit economics sheet. It will show us the economics behind each of the unit. So yeah, that's it about the cost structure. In this video, we discuss about first. We should say first we discuss about the theoretical part of the cost structure. Then we came to the practical, how to actually calculate cost for any venture. Okay, so yeah, finishing on this video. I'll see you guys on the next video. Yep, bye bye.